Australia's interest rate remains unchanged. Let's have a look. Good afternoon, everyone. Florian Heise here, and welcome to another episode of Heise Says. Still working on my Steiner coffee, and I thought we would have a look at this article, or not this article, this media release from Philip Lowe, the Governor of the Reserve Bank of Australia, about the, frankly, lack of a rate change. So our cash rate is still 1% here in Australia, which surprises no one, actually, but I thought we'd read through this and then have a look at a few things. So, at its meeting today, the board decided to leave the cash rate unchanged at 1%. The outlook for the global economy remains reasonable. There's his favourite word again. That's it, reasonable. We should make a drinking game. Whenever he says reasonable in his speech, you've got to swig a beer or do a shot. However, the increased uncertainty generated by the trade and technology disputes is affecting investment and means that the risks to the global economy remain tilted to the downside. In most advanced economies, unemployment rates are low and wage growth has picked up, although inflation remains low. The slowdown in global trade has contributed to slower growth in Asia. In China, the authorities have taken steps to support the economy while continuing to address risks in the financial system. Okay, so unemployment's low, wages growth has picked up, and inflation remains low. But the slowdown in Asia, I think, is going to certainly affect us. And I'll bring up my favorite website here, the Observatory of Economic Complexity, and it's a great way just to get an understanding of Australia's economy, our export economy, where they're going, who we're trading with. And iron ore, look, 20%, and iron ore's just gone down as well. I remember I watched an episode of, I think, Interest of the People, or maybe CEC, and people in Western Australia were hoping the iron ore price would increase their property values. It doesn't look like it's going to happen. But if you look here, what we're importing, refined petroleum, which apparently we only have 28 days in the country, which is, fantastic with the dollar the way it is. But look at our exports, the destinations for our exports. Okay, the destinations for our exports. So if there's a slowdown or slower growth in Asia, and we're exporting a lot of raw materials that help support that growth, well, naturally that would flow through to our economy, one would assume. Or it needs to be replaced by local manufacturing here in Australia, which certainly exists, doesn't it? Maybe I'm trying to find somewhere to get Steins in Australia. I really am, and sadly they're just for the 10,000 subscriber, I want to have them available for people to buy, and I can't find anywhere that can make them at a reasonable price. So if you know of someone or a manufacturer here in Australia that could make me a Stein, let me know. Please let me know in the comments, because I may need to help support that Asian growth there with my Stein purchases. So, global financial conditions remain accommodative. The persistent downside risk to the global economy, combined with subdued inflation, have led a number of central banks to reduce interest rates this year, and further monetary easing is widely expected. Long-term government bond yields have declined further and are at record lows in many countries, including Australia. They're at negative in some countries. Borrowing rates for both businesses and households are also at historic low levels. The Australian dollar is at the lowest level of recent times, although I think it jumped up to, 70 cents when I just checked a moment ago. AUD to UDS, and no, hang on, we'll just jump here, 68 cents when I just checked at 4:30 or 4:03. So there you go, still pretty low. This is above 67. Yes. Economic growth in Australia over the first half of this year has been lower than earlier expected, with household consumption weighed down by a protracted period of low income growth and declining house prices. See, that's the thing. If house prices declining decreases consumption, then people are leveraging the equity in their house to consume. That's probably not the smartest thing to do. We read an article the other day of a gentleman who was complaining that he'd got a $600,000 mortgage. You know, he bought a house for $250,000 and it ballooned to $600,000 because he kept drawing upon the equity. And I've got another article I want to look at today where it just shows you that people's understanding of the good times aren't going to last forever. And really, I think the problem we're seeing here, we've got a generation of people that are too young to remember the last recession, that are too young to remember it. I still remember it just because my father was in the construction game. And I remember the stresses that he would express at home because, you know, his projects would slow down. His office was dead quiet. He had to get his draftees from his office, had to hand him a shovel and say, okay, you've got to now dig foundations because I've got no drafting work for you. What do you think they did? They didn't have any of the job snobbery that we're hearing about today. They dug foundations to put the concrete in. Anyway, back to the article. Looking forward, growth in Australia is expected to strengthen gradually from here. I'd like to know why. Why is it expected to strengthen gradually from here? Could someone please let me know? Our manufacturing is very low. All the indices about services industries, you know, the PMIs, they're low for Australia. Our retail sector is in recession. Why is this his way of saying it's bottomed out? Is that what he's thinking? I don't know. I just did a video today about rental returns in Sydney are dropping for a lot of their apartment buildings. We're seeing again and again examples of, you know, the triangle of fail in Sydney or failure of all these buildings with construction issues. How can he make that statement? Can someone let me know if there's anything behind that and where I could find that information, because I'd appreciate it. The central scenario is for the Australian economy to grow by around 2.5% over 2019 and 2.75% over 2020. The outlook is being supported by low levels of interest rates, recent tax cuts, ongoing spending on infrastructure, signs of stabilisation in some housing markets. It was a 0.1% uptick and a brighter outlook for the resource sector. Iron ore's just gone down. Well, hang on. Ore price. I'm looking this up now. Here we go. One sec. I'll bring it up on this other screen and we'll have a look at that. So, okay, we'll bring it here. I mean, does that look good? That's, you know, what was it? 117 then, the 30th, and now it's 100. So 17% reduction. Okay, cool. Yep. No, I'm not going to unlock that. Sorry. I'm going to reject their workbook. So, okay, cool. I'm not sure about that. I'm not confident about that. But maybe, you know, someone point me to some more information. Point me to some more information. Maybe it's just the circles or the news that I'm looking at. But then again, I'm skeptical of all of this, the monetarist policy. I'm studying too much about the Austrian school, and I actually want to do a video about how my architectural thesis has primed me to really appreciate that school of economic thought. And when I studied economics years ago at uni, before I saw sense and decided to do architecture like all the cool people, I don't remember how much, if anything, we got of the Austrians. I think it was only very little in passing. Anyway, the main domestic uncertainty continues to be the outlook for consumption, although a pickup in growth in household disposable income and a stabilization of the housing market are expected to support spending. Well, I mean, we'll look at consumer confidence. It's trending down. We'll see how that's going. I mean, GDP growth is trending down as well. Okay, we'll see if he's accurate in those assumptions. But I mean, you know, these are economists, guys. More and more, I'm seeing we've got an emergent system here, and they think they're like mad scientists in evil villain movies where they think they can control the weather with their magnificent interest rate levers. So, employment has grown strongly over recent years, and labour force participation is at a record high. Well, that's only on the ABS statistics, and I will write down the time here, 9:50. I'll put a card up to the Roy Morgan alternative unemployment rate here in Australia, which I think is much more realistic. And what you want to do is you want to look at just not unemployment, also marginal people who are marginally connected to the workforce. Okay, you want to look at that rate, and that's sitting close to 20%. 20%. And youth unemployment in the regions too, it's a really big problem. Just look at what happened to Spain. Look at what happened there. So there has, however, been little inroad into the spare capacity in the labour market, with the unemployment rate having risen slightly to 5.2%. The unemployment rate is expected to decline over the next couple of years to around 5%. Wages growth remains subdued, and there is little upward pressure at present. You can't have both, can you? Unless you've got a really shooting up economy. You're going to see a decline in unemployment, then wages will go up when there's a shortage of people in particular markets. But unless you artificially force wage growth, and that'll increase unemployment. Caps on wage growth are also affecting public sector pay outcomes across the country. A further gradual lift in wage growth would be a welcome development. Taken together, recent labour market outcomes suggest that the Australian economy can sustain lower rates of unemployment and underemployment. The recent inflation data were broadly as expected and confirmed that inflation pressures remain subdued across much of the economy, except for the 10% rise in petrol at the last quarter, but we won't talk about that. Over the year to the June quarter, inflation was 1.6% in both headline and underlying terms. The central scenario remains for inflation to increase gradually, but it is likely to take longer than earlier expected for inflation to return to 2%. In both headline and underlying terms, inflation is expected to be a little under 2% over 2020 and a little above 2% over 2021. Oh, well, they want to get you spending. They want to get you spending, guys, any way you can. Conditions in most housing markets remain soft, although there are some signs of a turnaround, especially in Sydney and Melbourne. What does it take? Okay, they need to treat a turnaround in the economy in the same way that they treat a recession. Okay, they're not officially saying we're in the recession because we haven't had the required quarters of negative growth. And now if we happen to have 1 month of slightly positive growth in the housing prices, tiny, they're saying it's a turnaround. Maybe it is. I can't. It doesn't make sense to me. Maybe I just don't understand all these things. It's just too complicated for me to see, you got a 7% reduction in rent. We've got foreign investment down. How's there a turnaround? Anyway, growth in household credit remains low. Demand for credit by investors continues to be subdued, and credit conditions, especially for small and medium-sized businesses, remain tight. Mortgage rates are at record lows, and there is strong competition for borrowers of high credit quality. Yes, there is. Time to get discounts, guys. Time to get discounts. But there's also people at mortgage stress and in arrears. It is reasonable to expect that an extended period of low interest rates will be required in Australia to make progress in reducing unemployment and achieving more assured progress towards the inflation target. The board will continue to monitor developments in the labour market closely and ease monetary policy further if needed to support sustainable growth in the economy and the achievement of the inflation target over time. Well, let's have a look at some other figures just to think about. So we'll have a look here. This is the manufacturing PMI, and this is a quantitative figure derived from qualitative data. So they survey manufacturers with quite specific questions to hopefully remove emotional bias from it. Like, is your production or are your forward orders up or below from the same time last month? And that's how they figure this out. And I'll do another video going through how the numbers actually worked out. But if the number's over 50, it's generally there's more people positive, and if it's under 50, the people are less positive or they're negative. So it's gotten worse. So over 50 gotten better, below 50 gotten worse. So Nigeria has gotten better, Saudi Arabia better, UAE better, Greece better. But we'll have a look at all these wonderful countries that are better. Australia is better. So last we were at 49.4. So now it's gotten higher here. Also Hungary, New Zealand, Netherlands, United States, slightly better. So these are all pretty close to 50, is even 51. And you can see here what the range for Australia was, up to 62.5 down to 29.47. So then we can see all the countries here that things have gotten worse. Particularly if they've changed from the last one. You can see how it's going down. And I'd say manufacturing is just something to keep an eye on, because that'll flow through to all the other sectors of the economy, particularly. Well, let's have a look. Where's China here? China, 49.9. It's gotten better, but still generally worse. Singapore, so Japan, so yeah, South Korea. So there's a few Asian countries that are in the negative zone. Philippines is doing good. So it's one to keep in mind, because it'll flow through to our export destinations. And another thing to look at is here is the cash rate here in Australia, the interest rate. And we can see here we are now, right down close to 0, 1%. Look here, remember this? 2008? What happened there? That was the fuel we had in the tank for the GFC. And I'll do another video where John Howard is critical of lowering rates too fast, because now we've got nothing to do here. Unless they go below this 0 line, which is the negative interest rates. The theoretical dream of the moneyists, the monetarians. People who want to manipulate their levers to adjust the economy because they know better. They can control an emergent system with out-of-date data. You've got to remember, all the stuff we're looking at here, it's all out of date. It's not real time. It's all out of date. So I guess, I mean, it depends what you consider out of date, but it's not accurate to the instantaneous second. But anyway. So guys, yep, that's just interesting to see how it's changed over time. Anyway, thank you for joining me for this episode. Please like, share, subscribe, ding the bell to get my at the moment, try daily updates. We're seeing how many I can get out at the moment. We'll see. And if you'd like to support the channel, guys, I've got Subscribestar, I've got Patreon, and I'm looking at getting them all sorted out and organized a bit better. But thank you to everyone who's supported me and everyone who's watching. Take care, guys. I'll talk to you later. Bye for now.